Welcome back to another episode of Investing Explained. Here's today's question. Warren Buffett has a different approach to why he's investing. Aside from just enjoying the process and providing for his family, he wanted to compound his wealth and have his wife, Susan Buffett, give it all back to charity. Now, sadly, Susan Buffett passed away back in 2004, and Warren Buffett later decided to pledge more than 99% of his net worth to charity, primarily to the Bill and Melinda Gates Foundation. Now, you might be saying then, for good reason, that you're not a multi-billionaire, so how does this principle of holding a stock forever apply to the rest of us? Now, here I would say it's more the mindset, more than anything else, that I suggest you take away from that quote. You want to invest in a company that has such a substantial competitive advantage that you could hold it forever. That is how you should start your investment process. You don't want to invest in a pharmaceutical company and plan for them to have a drug approved, then the price of the stock would pop and then planning on selling it off. That's typically not how to think about value investing. Now, value investing is for the long term, and you would want to create a portfolio that won't be fundamentally changed if the company has a bad quarter or if the company is tanking, which you might argue could be happening right now. I don't recommend that you spend any of your investment income to pay for household expenses or similar, as you mentioned, before you're retired at the earliest. Rather, I suggest that you'll spend less than you make to have a standard of living you want and invest the rest and expect not to touch it for 30 years or more. It's really the compounding effect that kicks in here if you decide to wait. Now, we all have different approaches of how to do this depending on our skill set and personality types. Try to make it as easy as possible for you as you can, which is another way of me of saying do not consider your investment income as money you have access to before you retire. Now, if you are set on having an investment income before you retire, one solution is to invest in a dividend income portfolio where perhaps 50 to 80% of the earnings are paid out in dividend and live off of that. And this is good, especially if you're okay with knowing that you might have gotten a better return if you selected compounding stocks that didn't pay out a dividend. The other solution is simply to sell a fixed percentage of your portfolio every year, say 2%, and treat it as your income. Knowing that the stock market in real terms have yielded 7 to 8%, you'll still on average compound your portfolio and have a steady stream of cash flows from your portfolio.
And I really like the idea that you're touching on here with Buffett's quote about holding something as long as you possibly can. And like Stig said, you're trying to buy a company that has just this enduring competitive advantage. If you follow anything Buffett related, he talks about this idea a lot. I'm going to read something from the start of The Intelligent Investor. Warren Buffett wrote the preface to The Intelligent Investor, at least the more modern publications of The Intelligent Investor. And one of the things that he writes here, he says, whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as the amplitudes of stock market folly that prevail during your investment career. And then he goes on to write, the sillier the market behaves, the greater the opportunity for the business-like investors. And so what he's talking about there is not only do you have to lock in these companies that have these enduring competitive advantages, but you have to seize the opportunity when the market comes along, and it doesn't come along often, where it gives you these really juicy prices. And so when you look at, let's just take his investment in Coca-Cola. He locked in such a juicy price whenever he purchased Coca-Cola that the dividends that he collects on that investment from way back when, he's owned it for decades at this point, the dividends that he's receiving on that principal are absolutely massive if you looked at it as a percentage. When you're looking at the dividends at today's prices, it doesn't look like that. But when you look at the price that he purchased it for, that principal, compared to the dividends he's getting now, they're massive. And if he'd sell that position, his capital gains would be massive. So he was able to lock in these really amazing prices because of the market folly, the way that he described it. That's his verbiage. Because of the market folly that he was exposed to at that particular time, he was able to lock those prices in. So I would tell you that it's both of those things. It's buying at these really odd, advantageous times where the prices are just absolutely great, combined with a business that has this enduring competitive advantage like the Coca-Cola brand. So just some thoughts to think about. I think that's what he's really addressing. If you find that you have a company that you didn't really get a great price on it, the competitive advantage was average, you really don't have big capital gains, and you feel like you can plow that money that's currently maybe sitting in some type of security that represents all those ideas, and you could turn it and put it into something else that does have all those advantages of a great price and a long-term competitive advantage, I think Buffett would tell you, sell the position and move it into the other pick. But I think those are some important things for people to think about, and I think that's the essence of what he's getting at with the quote.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.